Welcome everyone. I'm Chaudhry Zishan, and today we are diving into an absolutely fascinating explainer all about wealth preservation. I mean, have you ever actually stopped to wonder what the ultra-rich do when the economy starts looking a little grim? Well, today we're decoding a very specific strategy. We're going to analyze why one particular mega-cap tech company acts like an absolute financial fortress. We're talking about Apple stock, and exactly how it serves as the ultimate billionaire hedge against economic volatility.
Okay, so let's just dive right into the big question. Where do billionaires hide their money when markets panic? Because look, when inflation bites, when interest rates shoot up, and those recession fears start looming, the average investor usually panics and sells. But large institutional investors, billionaires, they don't panic. They go shopping for armor, and increasingly, that armor takes the shape of the Apple logo. Now, it might seem kind of unexpected, right? After all, it's a consumer electronics company. But as we'll see, the sheer mechanics of its business model make it a definitive safe haven during financial storms.
To truly get this, we're going to break down Apple's defensive moats one by one. Here's our roadmap for today's explainer. 1. The volatility playbook. 2. The ultimate cash machine. 3. An unbreakable ecosystem. 4. The quality compounder. And 5. Is Apple recession-proof?
Let's start with Section 1, the volatility playbook, decoding the wealth preservation strategy.
So, to understand Apple's appeal, we really have to understand how institutional behavior shifts the second the broader economy falters. When panic hits, we see what's called a flight to quality. This is a massive market phenomenon where capital just abruptly flows towards profitable, globally dominant, and cash-rich companies. Investors treat Apple almost like a defensive growth stock. That basically means it's this rare breed of company that actually still grows, but offers way more stability than smaller, speculative tech firms. And Apple literally hits the nail on the head for all three categories. It's wildly profitable, unquestionably dominant on a global scale, and sitting on a mountain of cash.
Moving on to Section 2, the ultimate cash machine, surviving the storm with liquidity.
When a recession hits, cash isn't just king, you guys. It is oxygen. And this is where Apple absolutely separates itself from the pack. Even during much weaker economic periods, Apple just keeps generating tens of billions in free cash flow from its whole suite of products and services. We're talking the iPhone, the Mac, the iPad, the App Store, Apple Music, the whole shebang. This incredible sheer volume of capital generation, that is its primary defense mechanism.
The crucial thing to understand is how that cash flow translates to actual corporate survival. Think about it. During a recession, consumers spend less. Financing gets way more expensive, and as a result, average, weaker firms just choke on their debt and struggle to even survive. But Apple's balance sheet is basically bulletproof. It has so much liquidity and profitability that it completely self-finances. It can just keep operating aggressively, buying back shares, paying out dividends, and investing in new products without any real financial stress, all while its competitors are practically forced to pull back.
Plus, Apple has cleverly engineered its revenue to be deeply defensive through its services sector. If hardware sales happen to take a dip during a slowdown, this recurring revenue profile acts as a massive stabilizer. You've got predictable, recurring fees coming in from the App Store and AppleCare. You have high-retention data storage with iCloud. And let's be real, nobody wants the anxiety of moving a decade's worth of family photos just to save $3 a month, right? And then you've got subscription revenue smoothing from Apple TV Plus and Music. This recurring, steady profile is exactly what big money absolutely craves during volatile periods.
Section 3. An unbreakable consumer ecosystem, the power of brand resilience.
You see, it's not just about the financials on paper, it's really about consumer psychology and total brand lock-in. Between the iPhone, the MacBook, AirPods, and the Apple Watch, you have this massive ecosystem dependence. When you own one Apple device, let's face it, you probably own 2 or 3 or maybe even 4. They all just talk to each other seamlessly. And that means someone heavily utilizing this combination of products and services is incredibly unlikely to switch over to a completely different platform, even when their personal budgets get really squeezed. Which brings us to the core thesis of their brand resilience. While consumers might delay buying normal discretionary goods during a recession, Apple products retain amazingly strong demand. It's this powerful mix of intense brand loyalty and absolute platform dependence. This recurring customer behavior creates a highly predictable revenue stream, and if there is one single thing billionaires want when the market is crashing, it's predictability.
Section 4. The quality compounder effect, the Warren Buffett approach.
To really grasp this compounder effect, we have to look at the Warren Buffett approach. Long-term investors completely run away from speculative assets during downturns, and they look for proven mega-cap companies. Just look at Warren Buffett's Berkshire Hathaway. They famously made Apple their largest equity holding. And why? Well, the company boasts incredibly high returns on capital, the management executes really aggressive stock repurchases, and, as we've seen, the business possesses wildly durable competitive advantages.
Now here's where the magic really happens for wealth preservation. When market volatility hits and Apple's stock price inevitably takes a dip, their massive share repurchase program kicks into overdrive. Suddenly, their mountain of cash buys back way more shares at a discount. Because there are fewer shares out there in existence, earnings per share spike faster. So without lifting a single finger, long-term holders literally gain a larger ownership stake in the company. Apple's mechanics literally turn market fear into increased shareholder value. It's brilliant.
Section 5. Is Apple recession-proof? The important caveats. Look, no analysis is complete without objectively looking at the vulnerabilities, so we definitely need a reality check here. The simple answer is no. Apple is not completely immune to economic gravity. During severe downturns, they do face real risks. iPhone sales absolutely can slow down if consumers are hurting enough. Their massive global supply chains can face major disruptions, and valuation multiples can compress, which just means the broader market isn't willing to pay as high a premium for the stock as they once were. However, context is everything, right? Despite these very real vulnerabilities, when you compare Apple to the broader market, investors consistently view it as one of the absolute safest long-term equities you can hold during periods of uncertainty. It truly remains the definitive harbor in a financial storm.
I want to leave you with this really powerful summary of the billionaire playbook. Own dominant businesses with durable cash flow when fear creates discounts. That philosophy has historically worked exceptionally well for long-term investors in companies exactly like Apple. And it really forces us to ask ourselves, when the next big economic storm hits, will you be caught holding speculative gambles? Or will you be hiding in the cash-rich fortresses, hiding right in plain sight?
I really hope this breakdown gave you a totally new perspective on how the ultra-wealthy navigate market chaos. If you want to keep learning and mastering these wealth preservation strategies, go ahead and hit that subscribe button right now. Join me, Chowdhury Zishan, for more structured, analytical explainers just like this one. Thank you so much for focusing in today, and I'll see you in the next explainer.